FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. It's Kerry, Lutz, and I'm back from an extended weekend. Hopefully the shows that were up there were enough to satisfy your insatiable thirst for FSN programming. If not, we got 3 shows going up today. Date is April 21st, 2015. Hopefully you survived the 15th still intact. Your finances intact. And with us is none other than the one and only Jason Burack from Wall Street for MainStreet.com. It's been a while since he was on last. We're talking, at least initially, about dividends. Jason, hopefully you've been well?
Yeah, I'm doing pretty good. Just been really busy with a lot of projects at Wall Street for Main Street. We just put out a new dividend report, and we're in the process of crowdfunding to grow faster. So a lot of things going on at Wall Street for Main Street. Kerry, the new website just went up too.
Right. I saw that, and so dividends, which basically when Wall Street started, okay, which many of you may not know, pretty much people, when you bought stocks, you actually bought it based upon dividend yield. It was much like buying a bond, only the difference between a bond or a preferred stock was that you had no guarantees that the dividend yield would continue. So the economy went bad, companies would cut their dividends. They wouldn't go borrow a boatload of money to continue your dividend. And somehow, Jason, over time, dividend payouts changed a lot because of the tax policy. The country changed, wars interceded, and somehow the notion of investing, as it were, changed as well. Many investors then started chasing capital gains. So the notion of investing, the definition really changed. We go back to Benjamin Graham, the Bible of investing. Even to this day, I would aver, his seminal classic, Securities Investing or Security Investing, really covered how you analyze a company's financial statements to determine the predictability of the dividend, the stability of the dividend, and the possibility of surprises on the upside, either in the form of a special dividend or in the liquidation of the company that could yield rich rewards for the shareholders. So with that background, and you could add anything you like to it, tell us about your dividend report.
Well, a little bit of history there, if I could add some stuff on the history of dividends, because I find it pretty interesting too. I mean, there's always going to be people that are going to be chasing capital gains. We can go back to before the 1929 crash, Kerry, and there was a lot of people taking out, buying stocks on margin, and they weren't buying dividend stocks. They were buying the high flyers of the day. They were buying the radio stocks and some of those other stocks. So there's always going to be, people trying to get rich quick. I think that's part of human nature. I think we're just bred to be myopic in general, our brains, and we're not really as humans designed to be that good of long-term investors. So, but if you do read Benjamin Graham and you do read Peter Lynch and you do read Philip Fisher and some of the other great investing classics, some of the real greats out there, Sir John Templeton is another. You read some of those, you'll condition yourself better to be more durable in good economic conditions, bad economic conditions, maybe look to buy bargains. There's, countless examples throughout financial history of people like Sir John Templeton buying, dividend stocks during World War II, and, other classic examples of people buying stocks when there was panic and blood in the streets. And, they bought sound companies with not too much debt where the market had drastically thrown out the baby with the bathwater. So I think in general, though, now in terms of the dividend environment, in the past, companies were a lot more conservative with their accounting. They weren't as aggressive. They weren't doing this financial engineering that they're doing now. I've talked with people who have traded and invested, for decades, and they tell me the accounting now from decades ago is unrecognizable. So, free cash flow and dividends are some of the things that you can tell if a company is actually healthy now, compared to, the companies of the past. because there's just so many accounting games now that are played, Kerry, with companies that don't pay dividends, but they say they're making a lot of money in earnings, but they're taking out enormous amounts of debt and they're playing financial engineering tricks. I think Alcoa is one of the. I listened to your interview with John Rubino. Alcoa is known for that on the street, but there's lots of large cap technology companies now. I'm in a LinkedIn group, and they have financial engineering conferences every couple of months. I'm in that group. I don't go to the conferences, but they have them every couple of months for chief financial officers of large companies to learn the new accounting tricks to beat the earnings game and beat the analysts and move the stock price higher without the company, actually growing revenues. And I think that's why, stocks with dividends over the long term, they're going to outperform bonds because, you don't get normally with a good company that can increase their dividend. They can grow their top line, their revenue. They can do acquisitions. So they can come up with new ideas for how to grow revenue and come up with new products and services. And they can create shareholder value through either a higher stock price and or dividends. And you don't get that type of long-term outperformance with bonds or some of the other listed exchange investments that you have. And I think, as a long-term investor, the younger you get started, a lot of the younger investors, they don't like dividend stocks. But if you have some dividend stocks there and you take advantage of compounding and you just reinvest your dividends, and I know it doesn't seem like you're doing that well for the first number of years, but compounding over the long term, it works wonders. I think Albert Einstein said that compounding is one of the natural wonders of the world.
And another interesting thing, the first stock I ever really made money on, and I used margin debt, was a company. It was a master limited partnership called Plum Creek, and this was back in the 80s when interest rates were high. Plum Creek had been a spinoff of Burlington Resources. They were paying 16 or 19% distributions, and I don't remember. I didn't buy that much. It was a lot to me then. And I margined it, so I was able to buy twice as much. And then interest rates came way, way down. And I was able to really make a killing on it for me then, for the little bit of money I had in it. Dumb thing was I didn't do more, keep doing that. And you could just do such wonderful things. There's a story about a woman started with like $8,000. When she died, she had lived an incredible life, no luxury spared, and left something like $32 million just reinvesting those dividends. The second thing I ever did right in the stock market, and I've done a lot more wrong than I've done right, believe me, the dot bomb. I could tell my horror story, but I don't want to bore you with that. It's much more fun to talk about successes anyway. Utility stocks in the early 90s, stocked up on 6 or 7 of them, Con Ed, FP&L, which it was called back then, Florida Power and Light, PECO, the Potomac Electric Company, and a whole bunch of others, Texas Utilities. And again, they were not high flyers, but interest rates came down. They were steady performers, and it really... I just made 45, 50% returns in 2-3 years because of interest rates. So not to bore you with my few success stories that I've had in the stock market, but I was going to say that people, if you invest in dividend yielding stocks, when the market goes down, you don't go blowing off your shares, selling them. Your fellow investors in a dividend yielder are much different than people who invest in stocks for capital gains. They don't go panicking just because the stock goes down 10%, 15% in a week, because their goals are much different than the capital appreciation crowd.
Yeah, I think if they have the money to do so, if they have a certain portion of their portfolio for dividends and income, maybe they have some stocks in there that can produce some capital gains, but it's not the main objective of that part of their portfolio. It's just perfectly fine to go out there and buy, with the more speculative part, some growing miners or some resource stocks, or some technology stocks like 3D printing or robotics and things like that. But the people who you're exactly right there on the dividends and income. Those do reduce volatility in general, a lot of them, although the oil stocks have not been a great example of that. But I would counter, though, that the ExxonMobils and the Chevrons, they're down a lot less than the oil sector in general because they have steady, robust profits and cash flow from a lot of their other different operations. So, actually, we have a good amount of, there's 2 or 3 oil and gas stocks in our dividend report, and there's a couple gold and silver ones that are miners that are actually very conservative. There's one gold or silver company. It's not a miner, but it's actually a very conservative way to play the gold and silver industry. So you get paid 5% yield. Our dividend stock report has companies in it that are all over $500 million market cap. Most of the companies have very strong cash flows there. One of them even has, they provide equipment for the oil and natural gas service industry in the United States. And despite, Kerry, this fracking boom turning basically into a bust, it's slowing down rapidly now. And the oil and gas producers that did take out too much debt, either they're trying to sell the company now, or they're selling shares at bad valuations, or they're risking bankruptcy. This company was actually able to raise distributions 8% in this environment. They're doing so well; they have so much business. So it's a rarity there for most of those companies, because a lot of oil and gas producers, they slashed their dividend. ExxonMobil and Chevron didn't, but a lot of the smaller and medium-sized ones that were paying dividends did, and this company didn't. So I think there's opportunity in terms of bargains. You have to look at valuations. You have to look at sentiment in the market. As a value investor, you have to be a contrarian. And I think some of the best bargains for dividends in all over the globe, whether you're looking in the United States or Canada or in developing markets or Europe, is, I think, in the oil and gas industry.
Yeah, I totally agree with you. It's such a geopolitically sensitive market. It's also a nice call on geopolitical instability, of which there's so much of now. Look what's going on in Yemen as well. Not that I like to play negative trends in the world and scary trends, but you should be prepared for these things. You shouldn't be caught unawares, because this trend could wipe out a big portion of your portfolio elsewhere. So you might as well capitalize on it and have some portfolio insurance, if you will.
Yeah, the valuations for oil are very attractive. And also, if you go back and look at the at oil and the inflation rate, oil has tended, and maybe because there's some manipulation involved in this with the petrodollar and things like that, Kerry, and also oil's relationship with gold, but oil tends to over the long term, it tends to keep pace pretty well with the inflation rate. So, and I think a lot of that is because of the petrodollar, and because, the Saudis and the other large oil producers, if these fiat currencies are inflated too much too quickly, they start to, threaten to leave the petrodollar system or other fiat currency systems which were in place, and they start buying more physical gold to raise the price. So, I think there's a pretty good correlation there between the, when the inflation rate starts to actually pick up and the oil and gold price also both rising.
By the way, got a report from Dr. Frack, because the unemployment numbers have so understated the layoffs due to the oil price crash. So here's what Dr. Frack says, and he's there. He's on indefinite layoff right now. They didn't call it a layoff, but whatever they called it.
They reframed it.
Yeah, he's on vacation now, put it that way. Unpaid leave. 250,000 jobs lost in the oil patch now. Okay.
Yeah.
That's just direct. We don't know about indirect, but you could pretty much apply the 2-for-1 number.
At least. Yeah.
At least.
I was told the multiplier by someone who was 3 or 4 years ago that was touting how amazing the shale boom was, that it was 3 or 4 service sector jobs for every one direct oil job. That's what I was told. But I'm not sure the research he was quoting. But yeah, I mean, the oil market's had a really rough patch go of it for whatever reasons. Some people say it's supply demand, some people say it's manipulation, but whatever reason, the oil market has had a really nasty crash since June 2014. But I think we're putting in a strong bottom here, because, if the oil price stayed much lower, I think almost everyone, except for maybe the Saudis, was risking bankruptcy. If the oil price stayed much lower, there was a lot of supply that was going to come offline, Kerry. And even though a lot of these shale oil producers, they did hedge a pretty good amount of the oil production for the next, I think the hedges were on for 18 months or so. But
to 24, 18 to 24. Yes.
Yeah, but those hedges, though, they only have most of them only have another 6 to 12 months left. And I have contacts in Houston. I don't have your Bakken contacts, but I have a couple really good contacts in Houston with 35 years of oil and gas experience in the industry at different jobs. And from what they tell me, some of the smaller shale oil producers, even the ones that are hedged, the ones that have debt, like Whiting Petroleum, which is, I think, the second largest oil producer in the Bakken, they did an ill-timed acquisition of Kodiak Oil and Gas with billions of dollars in debt. They have $5 billion in debt now at the top of the market last year. And, they just did an emergency capital raise for debt and equity. And now, they're panicking still, even in spite of that. And, they're trying to sell the company. And there's other companies like that with Oasis Petroleum and the billionaire hedge fund manager, John Paulson, who has a large position in that. He has so much invested in the company. He doesn't like the valuation that he would get for his shares if he sold out. But, they're running out of ways to sell to raise capital. So maybe Paulson, who's a billionaire, will give them some type of emergency loan. Maybe he'll buy more shares then to protect the rest of his shares.
Yeah, well, what I find really interesting about this is the junk bond high yield market, not manipulated, all sophisticated, accredited investors, institutional market, right? Mm-hmm. Not being directly manipulated other than through the Federal Reserve as all interest rates are. So 4 or 5 months ago, we see that market collapse. We see yields go to higher than they had ever been. And everybody's looking around saying, what's going on? What's going on? Real bad precursor to rough economic times. And then 6 weeks ago, we find out, or 2 months ago, we find out, oil prices crash. Who's the leading issuer of junk bond debt? The oil patch. And it all makes sense. And this is what happens when markets are allowed to function.
Yeah, that's a free market right there. But the to add to your points there, I mean, the shale junk bond market is larger than subprime was. And from what I've heard from some of my hedge fund contacts, Kerry, who are looking for ways to secondary and tertiary ways to make money trading the oil price dropping, besides just either going long oil companies or shorting oil companies that are higher cost and have too much debt. What they've done instead is they've started to look into the annual reports of some of the banks, some of these smaller Midwestern regional banks. And Kerry, there's a lot of these banks that have not written off any of the bad shale oil junk debt yet. And so they're carrying non-performing loans on their books, and they don't have really any loan loss reserves, and they haven't written anything off yet. So I don't know what's going to happen there. I don't know if the Federal Reserve is going to bail them out, or the larger banks, maybe, what happened in 2008, how Ben Bernanke ordered Bank of America to buy Merrill Lynch. I don't know. Maybe that'll happen with some of these smaller and medium-sized banks, where the larger banks will be ordered by the Fed to buy up these things to prevent, contagion. Because once one decent-sized, medium-sized bank, and this holds true throughout all levels of the economy,
cascading defaults and crashes. We know all about it.
Exactly. Whether it's, Greece defaulting and, the banks are holding those bad loans, or it's one big bank defaulting and holding those big bad loans, it just doesn't seem like a lot of these central bankers anymore want to allow full free market forces. So, I love free markets, but I don't think the central bankers are going to fully allow them here. We may see some intervention with the banks holding up. They'll let the oil companies fail, Kerry, but if the banks are going to fail because they know that the banks are, funding the governments, I think they'll step in.
Well, I don't see where they're going to have a choice, because you know how this game works here.
Yeah, I do. I do. More money's printed up, and then the banks get the money to buy the bonds back from the governments, and that's how they keep the interest rates suppressed.
Yeah, this game has been played over and over. The one thing about it, though, is rather than having 10 million homeowners underwater, you got 1,000 companies, handful of banks, maybe 100, 200 banks. It's a lot more manageable from a logistics standpoint. You just line up at the window and you're swapping, figuratively speaking, you're swapping this for that, and it's done. It's all been done before. So don't lose any sleep. It's all going to be handled, but it damages the system. Don't get me wrong. I'm not making light of it. I'm just saying that this has all been done before. So this is what they'll do. Hey, so give us some names. Name names.
Name names for oil companies?
Yeah. You don't have to give away everything. Just give us a couple of breadcrumbs here.
Well, Chevron's very solid, around 3 or 4% dividend yield. Very solid. ExxonMobil is the bellwether of the industry. They're not in our report, but they're very solid. ConocoPhillips is a really good one, around 4% dividend yield. Good exposure to oil and gas. They did a bad acquisition in 2008, 2009, but I think they're over it then. These big companies, Kerry, a lot of them missed the shale oil boom. They 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 didn't invest super heavily necessarily into the Eagle Ford or the Bakken, but they also didn't get the boom, but they also didn't get the bust. So now these guys have a good amount of cash, and they are looking to do some acquisitions. So I would be surprised if they didn't go buy some assets on the cheap here. In terms of MLPs, Memorial Production Partners is an oil and gas producing MLP. They're hedged for the next 12 months or so, give or take, at $92 per barrel oil. So and they are so profitable compared to the rest of their industry for oil producing MLPs and other oil producers of their size that they just did $150 million unit repurchase, which is pretty rare in this oil price environment. Even though I think oil is bottom, there's just not many companies doing share buybacks or increasing their dividends. There are some acquisitions, but not as many as you would think quite yet. Maybe the larger ones are just waiting and being patient. So there's a lot of opportunities there. The main thing I would look for, if you're not going to pick out one of the ones I just mentioned, is look at production costs and look at debt. So if the company has cash flow and their production costs are not too high, and you can look up all-in production costs, and if you can't find it on your own, just email management or look at annual reports or PowerPoint presentations. And if you can't find it in their email, their investor relations department, try to get those numbers. And the other one is debt. The companies that don't have too much debt right now, they're gonna gain market share in this environment. So they're gonna. It's just like the Saudis. The Saudis don't operate with a lot of debt. The Saudis have gained market share if a lot of these shale oil producers go bankrupt. So I think the oil market has pretty much bottomed here. Maybe we'll go fits and starts up and down a little bit in a trading range for a while. But I think eventually we're gonna start going quite a bit higher, because there's just no way for a lot of these oil producers to earn a profit, and they can't be subsidized like a lot of the national oil producers. And we're starting to see the demand figures, Kerry. I don't know if you saw this, but the International Energy Agency, first of all, they said that the shale oil production would peak in 2020 in terms of production increases. But what they also said recently was that they project demand to increase a lot now because of these cheaper prices, that they're going to stimulate demand globally for oil, and that they expect the oil production to go from around 92 million barrels per day, which it currently is, to 94.5 by the end of the year. So that's a pretty big jump. So that's going to take out most of the oversupply that was in the market. The oversupply in the global oil market was not massive. The oversupply in the United States was massive, but not globally, because there's a lot of depletion. So as long as there's not a lot of oil production brought online by other countries, and the U.S. continues, the shale oil production continues to cut back unless the price goes higher, I think we're going to see a market that's more aligned with supply and demand, which means probably higher prices for the producers because they have to eventually make a profit. I
think you are correct. I think, not sure if we've hit the lows yet, but we're certainly close to it. That remains to be seen. But anyways,
well, Wall Street, Kerry, was saying, did you read some of the really funny comments? There were Wall Street analysts saying $10, $20 oil. There was one guy, he was from the Manhattan Research Institute. I don't know how much money this guy gets paid, but he actually said a couple of months ago, he said the oil price will never, and I say never, go above $50 a barrel again. That one was pretty funny.
Well, never say never. Should learn that in this business. That's for sure. But there's definitely trends going on. Remains to be seen. Jason, where do we find you? Crowdsource, tell us about that.
Sure. First, let me give your listeners a coupon code for the Dividend Report. I think I've teased it a little bit. There's 5 really good resource stocks in there that are of over 500 million market cap, conservatively managed, good plays for oil, gold, and silver, which are undervalued at this moment. They can get their coupon code by entering WS4MS25 on the wallstreetformainstreet.com website. And crowdfunding, I just want to bring to attention, if there's any SEC accredited investors, we're on AngelList now as of the last 2 weeks. We're an educational technology company, Wall Street for Main Street. We've had our business plan revised and helped with many of my technology contacts and savvy business people. And I really want to change the way, I know you're passionate about personal finance and investor education, Kerry. So we really want to change the way people learn business education, financial education, personal finance, investor education in many different asset classes, and also Austrian School of Economics. So that's what we want to do with virtual classrooms and live chat. And we want to basically bring the way people learn efficiently and cost effective, so they can have fun learning from very successful people teaching their expertise. And, it's probably going to end up, for a 1-year subscription, it's going to end up costing them the cost of like one college class. So for the price of one college class where they would learn from a professor who maybe it wasn't at Harvard, they didn't go to business school at Harvard, but they're paying, $1,800, $2,000 a year or something like that. And they're going to have the opportunity to learn everything they need to know to be a successful business person on one website.
Well, that really is a noble undertaking, Jason, and I wish you the best of luck on it. It's really a great thing you're doing. And you'll find the link, as always, in the show notes to this interview on financialsurvivalnetwork.com. Best of luck on this, Jason. Thanks so much.
Great. Always glad to be back.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.